Thanks for clicking. Canadian mortgage rates are on their way up as bond yields have broken sustainably higher than 4%.
Stop! He's already dead.
Indeed, while during the pandemic we saw insured mortgage rates fall well below 2%. As a result of rising yields, a decent 5-year fixed mortgage rate is now inching ever so closer to that of 6%. And while anticipation that the Bank of Canada will be raising rates at its September 6th announcement is no doubt at least in part at play in the rise in yields, there are also global forces at work, with major downward pressure currently being put on US Treasuries. And with US debt, at least for now, considered to be the safest debt in the world, as yields on US debt go up, so too do yields on Canadian debt, and mortgage rates follow thereafter. So what I want to do today is briefly go over bond yields, take a look at some of the pressures pushing up the yields on US Treasuries, and then discuss some of the effects on Canada's mortgage rates. How long these yields stay above 4% will be at least in part dependent on the Bank of Canada's rate decision coming out on September 6th, and we'll obviously have an update out on that decision on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into bond yields. First up, a brief refresher on bond yields. The price of a bond and its yield are inversely related. As the price of a bond goes down, its yield goes up. As a brief example, let's say I lend the government $100 at 10% interest, and I'm going to receive $110 back when that bond matures. I am yielding 10%. Now, let's say I run into financial problems, and I can't wait for that bond to mature. I want my money now. Jen has some extra money and some leverage and offers me $95 for that bond. So for Jen, the yield on that bond, the amount of money she can make off of that bond, has just jumped. It's just jumped to 14.6%, as Jen is going to receive that $110 back, but she only paid $95 for that bond. And this, admittedly simplified explanation is what's been happening in the international market as of late, as international players have been selling off US Treasuries. First, China, which has shrunk its holdings of US Treasury bonds down to a 14-year low. And while earlier this month a Chinese central bank advisor said that the selloff is increasingly a geopolitical issue, China has its own problems right now and has had to cut its interest rates. And when China cuts interest rates, it decreases the amount of people that want to buy its bonds. And as such, it decreases the amount of people that want to buy its currency. When demand for something falls, so too does its value.
He's lying.
And this has led to a depreciating yuan. So China needs to prop up the yuan, increase its value, and it does so by pulling its currency out of the market, decreasing the amount of currency that is floating around, and it does that by buying up that currency using US dollars. And where does China get its hands on US dollars? It sells its vast holdings of US Treasury bonds. This, in effect, decreases the number of yuan that are floating around in the market, thereby increasing the currency's value, and increases the amount of US Treasuries that are floating around in the market, thereby decreasing their value. So we have China having to spend, having to cut interest rates due to its own economic problems, and it's doing so by selling off US Treasuries. And when the value of US Treasuries fall, then the yields rise up. And when China floods the market with US Treasuries, the value of those Treasuries fall and yields rise. Canadian yields follow suit, and mortgage rates follow soon thereafter.
You stop it!
And it's not just China that's reducing its holdings of US Treasury bonds, with Saudi Arabia reducing its holdings to a 6-year low, and the Bank of Japan's about-face on its own interest rate policy, reducing the appeal of US debt. And with Japan, China, and Saudi Arabia being traditional buyers, traditional major holders of US debt, as those countries reduce their holdings of said debt, the price of US Treasuries will fall even further as more and more Treasuries hit the market, and yields will rise. The West, the United States, and Canada by extension, has been accustomed for at least the past 20 or 30 years to there being a globally insatiable appetite for its debt. Lending money to Tony Soprano, all things being equal, is relatively safe. The biggest guy on the block will find a way to pay his bills.
Should put us up to date.
But with US debt now fastly approaching $33 trillion and counting, and the value of that debt, the real purchasing power of that debt being eaten away by inflation, further economic problems in China, not to mention perennial worries over a potential default, as unlikely as that is, the allure of US debt is diminishing. The United States, the way it looks right now, is going to be paying more to borrow money, and as such, so too is Canada, and therefore, so too are Canadian borrowers.
We're done here.
Now, with all of that said, if there is a big international crisis, some black swan event like a major financial institution tipping over, which, as we saw with SVB, isn't out of the realm of possibility when US Treasury values fall. If we do see some big, unexpected, or even expected international crisis, then investors, then countries may full well pile back into treasuries, may full well pile into the perceived safety of US Treasury bonds. And if that happens, we will see the value of US Treasuries go back up, yields will plummet back down, and mortgage rates will follow thereafter as well. So if something really bad happens, we'll get lower fixed rates.
We can only hope.
But, for now at least, US Treasury bonds are seeing major downward pressure, which is pushing up yields, which are pushing up Canadian yields, which are pushing up Canadian fixed mortgage rates. Contrary to popular opinion, it's not just the policy rate which has an effect on the cost of borrowing here in Canada. Maybe for variable rate mortgages, but definitely not for fixed. And Western central banks don't have the power that they once did. In many respects, they've inflated that power away. While US debt, at least for now, and probably well into the future, will still have large global appeal, there will be a large market for that debt. That market is shrinking bit by bit, and we are seeing it show up in yields and, as such, in our mortgage rates. As it becomes more expensive for the US to borrow money, more and more, inch by inch, as we enter into a multipolar world, it's more than likely that it will get more expensive for Canada to borrow money as well. And, as such, it will get more expensive for Canadians to borrow money too. With that said, we will continue to track the price of Canadian money vis-a-vis interest rates on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.